Have you ever wondered, why is financial trading so captivating yet so challenging? To the point where people find themselves pondering over it day and night. As a trader, you may be all too familiar with these emotions, the thrill and tension when the market fluctuates, the joy of winning, and the disappointment or even regret when a trade doesn't go as planned. These emotions seem unavoidable, and often they become an invisible enemy, obstructing a trader's success. On the path to profit, traders frequently face hidden fears, a worry that even a small mistake could cost them the hard-earned investment they've built up. The fear of risk and loss is always present, even when things appear to be relatively certain. But does this mean that only those with natural talent or those who are inherently strong and courageous can succeed? Is it only those who are born with it who can survive and thrive in the financial markets? Or could anyone, if equipped with the right method and solid discipline, also find success? This question about success in financial trading puzzled two legendary traders, Richard Dennis and William Eckhart. They held opposing views on the subject and decided to seek an answer through a unique experiment, one that not only helped them test their beliefs but also offered invaluable lessons to generations of traders. Today, we will dive into the story of the turtle experiment, which took place in the 1980s, a story that has inspired countless people and proved that anyone can succeed in financial trading if they are equipped with the right method and strong discipline. For those who are new to our YouTube channel, welcome. Here we regularly share videos covering a range of financial topics, including Forex, cryptocurrency, and strategies to help you increase your income. If you enjoy this content, please feel free to like, share, and subscribe to our channel so you won't miss out on any of our latest videos. Thank you for joining us on this journey. Let's dive in. The story of the turtle experiment. Let's turn back time. At that moment, Richard Dennis was already a legend in the financial world, renowned for his outstanding success. He believed that financial trading was a skill that could be taught and learned. According to Dennis, with a clear method and thorough guidance, anyone, regardless of their starting point, could become a successful trader. On the other hand, his colleague and close friend, William Eckhart, thought differently. Eckhart believed that successful trading was an innate talent, a natural gift that not everyone possessed. He argued that only those born with certain traits could conquer the complex and challenging markets. The two friends debated endlessly, but neither could persuade the other. Finally, Dennis decided to conduct a bold experiment to settle the question once and for all. And so the turtle experiment was born. Dennis put out an advertisement to recruit a group of people who were completely new to finance and trading. In this group, there were people from all walks of life, doctors, engineers, teachers, and even a soldier. These individuals, who would become the turtles in Dennis's experiment, were not experts. They were ordinary people like us. In fact, most of them had never tried trading before. Nevertheless, Dennis had faith in his method and began to teach them. Over several weeks, he taught the turtles the fundamentals of trading, how to identify market trends, set stop-loss levels, and manage capital. But he didn't stop at theory. Dennis also taught them discipline and how to control emotions in trading, two elements that he believed were the keys to success. After this brief training, Dennis confidently sent his turtles into the real market. And what happened? The results were astonishing. Dennis's turtles, who had no prior experience, applied the method and discipline they had learned and quickly achieved significant profits. Many of them earned impressive returns, far exceeding initial expectations. The turtle experiment transformed many people's perspectives on financial trading. It proved that success in trading is not necessarily an innate talent. With proper guidance and instruction, outsiders from various professions, from doctors to teachers, could become successful traders. Valuable lessons from this story. Method and discipline are key factors. The story of the turtles emphasizes that in trading, method and discipline are of utmost importance. By strictly adhering to principles like following trends, setting stop-loss points, and managing capital, the turtles overcame the traps of the market. More importantly, they conquered their fears, managed their emotions, and maintained discipline to the very end. Consistency and patience in trading. The turtles were required to stay consistent, unaffected by short-term fluctuations. This demonstrates that success doesn't come from a few lucky trades, but from the ability to stick with a method over the long term, without wavering in the face of short-term volatility. Risk management is the key to protecting success. Dennis emphasized risk management, instructing the turtles to risk only a small percentage of their total capital on each trade. This helped to minimize losses when a trade didn't succeed, an essential factor in the highly volatile financial market. Simplicity and focus on the core. Dennis did not instruct the turtles to use complex tools, but rather taught them simple, easy-to-apply trading principles. This highlights that sometimes simplicity is more effective, as it eliminates noise and minimizes confusion in decision-making. A strong trading mindset. The turtles learned to control their emotions and resist feelings of euphoria or fear. This is a crucial lesson for all traders with a clear plan and set rules to follow. Traders know when to enter a trade, when to exit, and how to prevent emotions from influencing their actions. The story of the turtle experiment by Richard Dennis brings a powerful message to us, especially to those who are participating in or want to enter the financial market. Success in trading is not a natural-born talent. Instead, it's the ability to consistently apply a proven method and maintain discipline. The most crucial element is controlling emotions and adhering to a method. Facing the constant fluctuations of the market, traders are often swayed by emotions such as fear, greed, or hope. But when we have a clear trading plan based on specific rules, like those Dennis taught his turtles, we know when to enter a trade, when to set a stop loss, and how to prevent emotions from dictating our actions. So what lesson can we take away from the story of the turtles? Discipline and method are the two essential factors. If you have a clear plan and adhere to it with discipline, success in financial trading is no longer out of reach. The story of the turtles is a reminder that sometimes success doesn't come from innate talent, but rather from training and patience. Let this story inspire us and remind us that with some knowledge, determination, and discipline, anyone can succeed in this challenging market.